So fifth type of ratios we have is valuation ratios. Um, these ratios tell us about how the particular company is valued in the market. Um, this is very relevant ratio from investors' perspective, from potential investors' perspective, before deciding to make any investment, to buy any share or not. What we definitely need to look at is valuation ratios. A company could be doing great, um, consistently showing revenue growth, profitability growth, but it might be trading at very high value in the market already, discounting all these positive factors. So uh, that will not make for a very good investment if we are buying something very expensive, which has already factored in all the positives available related to that company. So, very important, we look at valuation ratios uh, along with other ratios also, which we saw, like liquidity, solvency, activity, and um, profitability ratios. We should also definitely look at valuation ratios. These are the financial metrics that offer an investor focused perspective on a company's performance and its appeal to the stock market. So, very investors focused perspective. Um, these are most relevant for the potential or existing investors in terms of their decision making whether to buy or sell the stock. They provide insights into how the market values a company's stock and its attractiveness to potential investors. So, how is the market pricing a particular stock? What is the value the market is giving to a particular stock with respect to its earnings per share, with respects to its EBIT, EBITDA? There are various valuation ratios we can look at. So, what is the value the market is giving to the company with respect to its fundamental factors, that is captured through valuation ratios? First one is price to earnings ratio, P ratio. It evaluates the correlation between a company's current stock market price and its earnings per share. So, it is calculated as CMP, current market price, divided by EPS. This ratio is telling us what is the price, per share price, the market participants are ready to pay for this company for per dollar of earning per share, right? So for $1 of earning per share, what is the price per share the market participants are ready to pay for that company? That is captured through PE ratio. Okay, so if it is too high, then we can say that the company is overvalued. If it is too high as compared to the industry average, as compared to similar companies, if it is too low as compared to other peer companies, we can say that the company is undervalued in the market. For example, let's look at TCS. We are looking at screener and we are looking at a set of IT companies, and here is the P ratio for those companies. Okay, so TCS is trading at a P ratio of 30, Infosys at 27, and so on. So what can we say here? That based on the P ratio, Persistent Systems is trading at a much higher P ratio than the industry average. The median of the industry is 33. So Tech Mahindra, Persistent Systems, currently they are trading at a higher P ratio than the median of the industry, whereas some other companies are trading at a lower P ratio as compared to the median of the industry. So we can say that the market is ready to pay 71 rupees for 1 rupee of earning per share. Yeah, so the market is giving 71 rupees. That is the price the market is ready to pay for 1 share of persistent systems for 1 rupee of earning per share shown by persistent systems. So that is a very high P ratio, uh, and there could be multiple reasons for this. Maybe persistent systems is showing a very high growth rate. Maybe the future earnings potential of persistent systems is higher than the other companies, or it could be they are moving into some advanced technologies which have a very good future potential. So there could be multiple reasons that we need to go more deep dive into before making the investment decision. But from a very simple perspective, what we can do is we can look at what is the average or median PE ratio for the industry, and accordingly compare that PE ratio with the PE ratio of our target company, and accordingly figure out whether it is relatively overpriced or underpriced. Similarly, we have price to book ratio. PB ratio compares a company's stock price with the book value per share, offering indications of whether the stock is undervalued or overvalued. So here we are comparing the current market price divided by book value per share. Okay, so what is book value per share? The shareholders equity we have in the balance sheet of the company, if we divide that by shares outstanding, what we get is the book value per share, right? So according to books, according to the balance sheet financial statements, what is the value per share? That is the book value per share. And the value at which the stock is trading at, that is the stock price per share. So stock price per share divided by book value per share will give us the P by B ratio. And accordingly, what we'll do, we will look at what is the average of the industry, what is the average of the similar companies, and then we can compare it with our target company and figure out whether currently our stock is trading at a much higher PB ratio or much lower PB ratio, and accordingly we can figure out whether it is overvalued or undervalued. One more point to add here is that price to book ratio is more commonly used in case of uh, financial companies like your banks, NBFCs, where their book, where the balance sheet includes a lot of assets or liabilities which are priced at market, right? So the book value is giving a much clearer picture as compared to other set of industries where the book values do not reflect the current market price. Next we have is the dividend yield. It represents the annual dividend payment as a percentage of the stock's current market price, providing insights into the return on investments from dividends. So what is the dividend the company is paying per share value? Let's say TCS is paying 5 rupees dividend and the stock price of TCS is 100. So for 100 stock price, they are paying 5 rupees as dividend. So dividend yield will be 5%, right? So higher the dividend yield, better it is from an investor's perspective. The investor is able to get higher returns in the form of dividends itself, right? So there are two forms of returns when we invest in the share. One is the dividend and one is the capital appreciation. So if dividend yield itself is 5-6%, that means even if the share price does not go up, we will earn 5-6% by investing in the share through dividends only. So higher the dividend yield, better it is in terms of a potential investment. Interpretation. Market value ratios are vital for comprehending how investors perceive a company's stock. A high PE ratio may imply high may imply high future earnings growth expectations, whereas a low PE ratio may suggest potential undervaluation. So, why would the market give a high P ratio to a particular stock? As we discussed, it could be because the market perceives it to be having a very good future potential. In future, the expected earnings are looking good, and that is why the market is ready to pay a higher price and make it trade at a higher P ratio, whereas a low P ratio may suggest the market is not very optimistic about the future potential of the company. They are not confident and they are not ready to pay a higher price for per dollars earnings per share. Whereas there is always a potential of mispricing in the market. So a high PE ratio may not always be fully justified. It can significantly uh, be seen as overvaluation in the market, and a lower P ratio could mean undervaluation in the market. Similarly, for PB, price to book ratio, here if it exceeds more than 1, then the stock is trading at a premium to its book value, and below 1, it is trading at lower than its book value. A higher dividend yield can be attractive to investors seeking income. For those investors who are seeking regular income in the form of dividends, the stock with higher dividend yield would be more meaningful. Market value ratios help in assessing market sentiment and guide investment decisions for both investors and analysts. These ratios are invaluable for comparing a company's stock with its peers and evaluating its performance within the context of its market value. Valuation ratios such as EV by EBIT, EV by EBITDA, EV by sales are financial metrics that evaluate a company's worth by considering its enterprise value in relation to its financial indicators. So earlier we were talking about current market price divided by earnings per share or book value per share. Here we are talking about enterprise value. So what is the total value of the firm? That includes our market value of equity plus market value of debt minus cash will give us enterprise value, and that enterprise value or the value of the firm divided by the EBIT the firm is generating, or the EBITDA the firm is generating, or the sales the company is able to generate. So we are dividing the firm value by these fundamental earnings or sales measures to find out the potential value given by to the company by the market. EV by EBIT quantifies the ratio of enterprise value to a company's EBIT. EV by EBITDA assesses the multiple of enterprise value to a company's EBITDA. EV by sales examines the ratio of enterprise value to a company's total sales or revenue. Right? So, depending upon different industries, we can use different valuation ratios to get an idea about how the market is valuing these companies, and accordingly make an informed estimate of whether the company is overvalued or undervalued. These ratios assist in providing insights into how the market values a company concerning its financial performance. A lower EV by EBIT, a lower EV by EBITDA or EV by sales ratio may suggest that a company is potentially undervalued or holds promising growth prospects. Conversely, a higher ratio may imply that the market assigns a premium value to the company. Application: valuation ratios are fundamental in the process of making informed investment decisions, aiding in the evaluation of a company's investment potential. Investors and analysts employ these ratios for comparative analysis within the same industry, helping identify potential investment opportunities. This is what we have already discussed. considerations to obtain a comprehensive assessment of a company's investment appeal. It is important to use valuation ratios in conjunction with other financial and qualitative factors. Acknowledging the significant variability of these ratios across different sectors, it is crucial to consider industry specific benchmarks. So again, as we are concluding our ratio analysis topic, it is very important, which we have reiterated during our videos, is that it is very important to consider these ratios in conjunction with the industry. For different industries, different ratios make more sense, and different standards or benchmarks or values of these different ratios would be seen for different industries. So when we are doing ratio analysis, we should always look at industry specific benchmarks, industry specific standards, and then we should do a comparison. And also it is important to identify which ratios make more sense for which set of industries. So although it is up to the analyst how they want to go about it, and we can have different justifications for which ratios we are using where, but in general, current liquidity ratios such as current ratio, quick ratio are used more for retail, hospitality, and manufacturing industries. Profitability ratios are used more for technology, healthcare, utilities. Net profit margin is used. Gross profit margin is used more for manufacturing and retail industries. Return on assets is used more in case of banking, telecom, and energy industries. Operating profit margin is more used in case of services, manufacturing industries. Return on equity is more commonly used in case of financial services sector and consumer goods industry. Return on capital employed is more used for utilities, manufacturing. Return on invested capital is used for energy, real estate, utility sector. Financial leverage is used for more capital intensive industries like real estate, utilities, telecom. Debt to equity, debt to capital, interest coverage ratio is used for, again, heavy capital intensive industries like airlines, real estate, energy, utilities, telecom. Efficiency ratios are more used for retail, manufacturing, wholesale, uh, services, construction, telecom, hospitality, and energy industries. And valuation multiples like P ratio is used for telecom, technology, healthcare, consumer goods industries. Price to book ratio is used for banking, real estate, utilities industry. EV by EBITDA ratio is used for uh, M&A deals, private equity deals, technology industry, and EV by sales is used for financial services, healthcare, and technology industries. So uh, that's that's all about ratio analysis. Um, Very important topic in terms of analyzing the financial data of any company, and uh, doing a comprehensive financial analysis. We should always use ratio analysis as a powerful technique. Thank you.